One of those.
Let me record, so it's fine.
Okay.
Oh, we've got it now.
Hi, everyone. It's Grant Abbott speaking. I'm here with Michael. How are you, Michael?
Good, thanks, Grant. How are you?
Good. Sorry about the delay, guys. It's just, technology. We're pretty good at LightYear Docs with presentations, technology and all that, but sometimes it just gets a bit wonky. But one thing is, if you're ever doing a Zoom, things aren't working, just keep on plowing through presentation skill. It's all about the way you deliver and what you're doing. So even if the slides aren't up and running and you're doing a by way of telephone, it still should be upped and pumped, and we really want to get into that. So we're going to look at a whole lot of property development using various structures. I'm going to give a couple of good ideas there as well in terms of the various stages of property development where your clients are. And feel free to, if you've got any questions or particular client issues, throw them into the Q&A and I'll look at them on the fly. This is a closed session mainly for our strategist members, so it's a bit of a deep dive in there. So let's go through. From my perspective, I started in the tax area when I got a bit of a bug in 1982 at the Merriweather, or the economics faculty at the University of Sydney. Came up across a tax book there by Peter Klein, How to Avoid Income Taxes, You Beauty. So that sought me on a path to glory from there. I ended up doing a law and then a master's of law specialising in tax and also international tax. So, but when I came out of there and I was working at the Tax Institute as a research director, then moved on to a KPMG as a manager. I got heavily involved in the property development side of things through various funds managers, including Mirvac, including Barclays Property Trust at those times, Macquarie, the list goes on. Virtually advised so many clients there. So I've always been involved in that property side and raising capital for property, not directly myself, but certainly in terms of understanding the structures. And I remember one stage there where I spent 3 days and virtually had no sleep going through a 1,000-page unit trust deed, which was a bit of fun. And, just it was around about 20 or 30 lawyers and we're just going through line by line, which was very painful. I was looking at it from a tax perspective, which was pretty important, obviously, for all of our clients. Particularly the fund managers, etc. So I've been involved with that, and then broke away, and then went and set up the very euphemistically named Grant Abbott Consultants, and I started doing a bit of power and really driving through structures for property, etc. At that time, and if we go back even earlier in the 80s, property syndication was pretty important. People used to get unit trusts, set them up, get a property, obviously develop the property in there, maybe keep the property on further when we were looking at just getting income from that property and essentially being off and running, which I thought was great. And it was great to actually see what could go there. But likewise, also, we have to understand that when we go through these structures, there's also the downside as well. I know the guys over in Western Australia, my good great Simon over there, he and his father's been involved in property development for a long time, and they still got one latent legal case that's been going after 20 years. So you just got to be really careful about that sort of time. Certainly at Abbott and Morley, Tony and I have been or have advised on more than $1 billion of transactions over the last 5 or 6 years, and that's just solely in relation to SMSFs rather than unit trusts, etc. So we've got that. That's our little specialisation there, and I want to cover a lot of the particular issues that I see that are really important. How to bring an SMSF in, but notwithstanding that, looking at setting up unit trusts as well. Michael, just to give a bit of background on your skills in terms of property development, capital raising, etc.
Yeah, thanks, Grant. I mean, from the cap raise perspective, I've been in CFO and COO roles in ASX listed and private entities, have raised over or been involved in the raising of over 500 million in Australia and the US, predominantly in financial services. although I have done, I've been involved in running a number of property trusts. And at one stage we acquired Mount Hotham and Falls Creek, which was quite a good project. Quite enjoyed. Luckily, I almost ended up in the side of the mountain.
On the plane, I know.
On the plane, yeah. I was at Melbourne Airport with an opportunity to jump on that with Brian and Kathy, and at the moment, I mean, this is quite pertinent, this webinar today, Grant, because property is just the flavour of the month again, or the flavour of the year. I mean, it's going gangbusters. I had my Smsf property in my Smsf valued, which in March, I think it was, and I've just had it again for end of 30 June accounts, and it's gone up $98,000 in a matter of 3 months, which is crazy, and especially for the type of property it is, and it's just I'm seeing that across the board at the moment, and I'm actually involved in the reasonably early stages of a group who's buying a golf course on the Gold Coast, and they were buying it. The couple of gentlemen who they're buying it for the golf course, but I've come involved in relation because it's quite a significant property play. It's probably the only lasting golf course on the coast that is a significant property play, and we've managed to get. We've been doing a fair bit of due diligence over the last couple of months, and we've got people who are interested in putting the money forward. But there's probably up to about $50 million in property to be developed on it. So quite excited about that.
I know, it's amazing, the old golf courses. But even seeing, I think one of the newer areas, because you will start to see, obviously, one of the big things is going to be land development or land and house. Which can be achieved. The problem is, look, I just had a look at the stats the other day. In fact, they just released yesterday that the average home price in Australia is $830,000, which has twofold. So I'm going to do a lot of property development today. I'm sorry, Mitch, my good mate Mitch, but rather than just straight property investment. So we're looking at property development at the big end of town, and even doing mile development. So I would look at buying a property and doing a reno. So flipping it, that would obviously in this market it's quite useful, particularly if you have a look at pockets up here in Sunshine Coast. The prices are just going crazy, which is also the other side of the equation, which I'll be looking at tomorrow. If you have the opportunity to book in just on our website. You can book in for tomorrow's session, but I'm going to be looking at a home protector. So looking at acquiring a family home within a trust and then being able to sell it as you go down the track later on, and there won't be any capital gains tax. So if you're looking at doing those flips, it's quite useful. In fact, I think you'll really enjoy that tomorrow, the way we set it up. But look, good, Grant, if everyone saw Laura jump in the chat and give their thoughts on property and property prices in the country at the moment. I think they'll go again once the border opens. There's a shortage in certain areas, but it's interesting to see what everyone's opinion is in this. Yeah, absolutely, and you'll see it's going to be interesting what happens with all the COVID and the border, but we're getting very isolated. And unfortunately, the other side of the equation is with the house prices going up so much that even the average person has got a lot of equity in these properties, as you just alluded to, Michael, and that means that they're exposed to litigation, obviously insolvency actions, also in terms of family provisions. So that little case that we saw, and I always talk about the Miller and Taylor case, where there was a 5-year fight over $600,000 that cost $500,000 in legal fees. That's not now virtually everyone in Australia is faced with that in terms of family provisions. So the protector is a really important tool there. But remember, tomorrow we're going to look at a new strategy called the home protector. In this area, the property development, you will get clients, and no doubt you'll get clients who'll be doing property development, whether it's small scale, it might be knocked down and putting up 2 townhouses, which I call small scale, or might be up to 200-300 apartment developments. When we have a look at that, obviously the key area that I see is that really most of you should be able to take that sort of work on. Now, even if it's a 300 unit development, obviously you haven't got the skills in terms of advising on the actual development side, but certainly in terms of the technical, the strategy, and the structural side is absolutely crucial from that perspective. So it's important for us to take that work on because it's definitely down that early adoption phase. Most developers end up going to large legal firms or large accounting firms. And as soon as you go there, that then cuts out the base of self-managed superannuation funds. They might troll along the bottom for SMSFs, and usually see it, that you got the prospectus or the IM and it says, blah, 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 property trust. Oh, good, it's like a stamp, good for SMSFs as well, which really, unless it's properly structured for an SMSF, it just doesn't make any sense. Just to get on, and so we want to use all these visionaries, even from this perspective. I'm going to start going back to the old school. Here you go, Mick. I'm starting to use the thing. So I'm sorry about my ugly hands, but that's okay. So typically we'd set up a unit trust, and this is if we're going larger scale. And I'm going to go through a few of these anyway. So we'd set up a unit trust, and traditionally we'd have a whole range of units would pop out of here. So that's okay. And then you've got clients who may well be companies, be discretionary trusts, and you might have a couple of lackeys there on SMSFs, etc. So when we go in through the property development, we obviously get the capital coming up from each of these unit holders there. And again, I'll look at the in-house assets, but assuming that they're all unrelated parties, they'll have a good corporate trustee sitting up there. And then obviously we'll have then the bank, which will then inject funds in there. And usually it's mezz finance, and mezzanine finance just means that, short term, maybe 18 months to 2 years to get that in. So that's a typical structure for that. So unit trust, whole range of investors, company, bank with mezzanine finance. And then obviously what happens is the end result is that they'll then sell off the assets. And then that unit trust itself will either be wound up or alternatively just keep on going and buying other properties as well. But usually they end up being special purpose unit trusts. Likewise, you can also use companies. If you're going down, probably if you're using this and it's a one-off development, you could probably argue that it may be a capital gain. But if you're a true property developer, it's going to be on revenue account anyway. So that's why there's not much difference between using a company and also a unit trust. Although I do like the unit trust a little bit better, and you'll see why. So that looks okay. And that's just like basic, boring, really. It's not my style. Grant, he doesn't like crap like that. That's so boring.
Grant doesn't do boring, do you?
No, well, I'm at that age of life that I've done enough stuff, and I've pulled enough people out of their shit to know how to fix things and make them a little bit different. So let's go back. And again, this can happen with a company or a unit trust with a structure there. So we want to make it conducive to SMSFs. Now, the fundamental problem that most of the developers, and more importantly their advisors, don't really understand is that within an SMSF we have different investment profiles, and that's simply required per investment strategy. So we're going to end up with a younger brigade, and they're primarily people who are in accumulation. Then we're going to get the older guys like Manish and myself. Sorry, Manish, I know you look pretty young, but I know you're an older guy like me. So we've got two elements there. We've got younger and we've got older. So the whole idea about any property development at the moment, although they get picked up pretty well, at the end of the day, the developer who's actually doing this is not doing it for love. So there's no such thing as a there's no such thing as a pro bono developer or a charity developer. You know, they want to maximize the profits. So they're looking at who the unit holders are, and traditionally they just go ahead and build it. You know, this old style, you know, and they'll go and build that, and they'll go out to the market and they'll raise capital and all that, and we're off and running. But again, I mean, they're missing out on the big picture. So one of the problems about that is when we're having a look at that style, and we're having a look at individuals investing in those property syndications, etc., you're really drawing from a small pool. And the reason I say that is that when we have a look at Australia's investment horizon, we've got industry funds and retail funds, and mark my words, within 10 years, there'll only be 5 superannuation funds across Australia, and primarily 3 of those will be retail funds, which is why there's a lot of aggregation there. So when you have a look at that, there's about I think around about $1 trillion in retail. In fact, about 1.2 or 1.4, I think, trillion in retail and also industry funds. In terms of self-managed super fund, you may have seen the latest stats. There is over 800 billion. So that's not million, there's $800 billion sitting inside SMSFs. So what I'm going to do is I'm actually going to, instead of this, which is build it for everyone, what I'm going to do is show you a couple of mechanisms for building things just for self-managed superannuation funds, if you mind me. Because again, the developer here, because even if we build it specifically for self-managed, we can always come back and add additional investors. Whereas if we just, if we're building it for the kitchen sink, then you're going to end up with a whole lot of rubbish. So what I'm doing is I want to target this and build that in there, particularly when you have a look at the underlying, interest rates, particularly down to these pension guys, it's pretty bad. So when we do the development, the horizon of the development needs to be taken into account. So first off, we've got the build phase. So the build phase is inherently risky. So it means the underlying interest rate, the MES rate is, what's a MES rate, do you think, at the moment, Nick?
We're probably, if I use my clients, 12s, 15s, up 20s.
Yeah, 12 to 15%. And usually it's around the item to build. So you're probably looking at, maybe an 18-month to 2-month or 2-year contract. So it's inherently risky interest. Likewise, and here's the first thing, the development investors are going in for a high yield, but they are also potentially in there to lose money. And we've all seen that. I think the classic one that we should all be watching out at the moment is that I'm a little bit concerned about is that Evergrande over in China. We can see that they've dragged money in from the Chinese punters, built all these apartments that actually no one's buying. And it was a matter of time that they're getting crunched, and they've got a whole lot of bondholders, $300 billion. So it's going to be interesting to watch how that plays out. I think personally, look, I've got no idea, but I think personally, President G is just going to let the whole thing collapse. We'll see anyway. So,
Grant, do you mind just making the screen a little bit bigger? It's just cut off a little bit at the bottom.
Just cut off the part that says developer, investors, and yield.
How's that?
You might actually just need to adjust the.
Okay, yep, I got the picture. Yep, how's that?
Visualize, I think.
Is that better?
Oh, I still
can't read at the bottom.
Okay.
You can sort of see, I can see it a little bit, but.
There we go.
Yeah, that's better. That's better.
Okay, thanks for that. Yeah, so when we have a look at that, and then on the other hand, we've got people who, like, if you're going to go and invest in property, just generally, so this is one for you, Mitch. What you're looking at doing is obviously buying a property, and you want to buy it at a discount if possible. You obviously want to get a good long-term yield. And obviously have secure tenants. So that's a great income flow for the older person, if that makes sense. Again, when you have a look at it, if it's fully paid off, you're getting maybe a 2 or 3% yield. The good thing about the market at this place is that rents are extremely tight. If you're up here in Sunshine Coast, you know, you can't even get a rental. They've got people living in their cars. Unfortunately, it's not a good position. But that doesn't mean, I mean, there's so much, you know, you go a kilometre the other side of the Sunshine Coast motorway, and there's, you know, thousands of acres which ultimately will be developed. And, you know, there's huge development going on in Maroochydore and stuff like that. So when we have a look at that, we look at those profiles. So this MES one here, that looks pretty good, pretty attractive for these guys. But that doesn't mean that some of these older guys don't want to have a bit of an uplift through that MES, because, you know, that's pretty attractive. You know, you're going to get a good rate of return, because that MES finance. So here's interesting. This is where we're starting to build. That MES finance generally comes from a bank, but it doesn't need to come from a bank. It can come from here, or it can come from here. Does that make sense? So that, again, this is, remember, this is arm's length. So we've got our, you know, corporate trustee, you know, independent. So there's no, we're not worried about in-house asset issues. So this is a true property development. And this would be like for a 2 mil or upward development. So what I'd be looking at doing is building, when I'm coming around to this stage, building units for this. So this would be a separate units which are financed. So in fact, you don't even need to do that. So these would be called dev units. So development unit, obviously, we'd take out the interest. So the first thing is, what I've got there is, and I'll come back to this one, I'll just get another page. So the first profile that we're going to look at is for the accumulation guys. Now, just as an aside on this one, when you have a look at it at this present point in time, there is in excess of 800, in fact, I think it's up around 800 billion to $1 trillion, which is sitting in retailer industry. So when we have a look at that, that's a lot of money that can ultimately be switched over to SMSF. So again, this family SMSF concept is really important. Bulking up, pulling money out of these funds and putting it into the family SMSF. That was the whole design of getting the 6-member funds, is to effectively attack the industry funds. So on the accumulation side, we can do a number of things. First off, we could provide MES finance. So when we provide MES finance, you need a good loan agreement. Obviously, you want to take security over the assets, etc. So that in itself is a good investment for the accumulation, and probably also the more riskier pension. So you're not going to put all your pension in there, but you might put, you know, like 5%, because you're going to end up with a good, as Michael said, probably a 12 to 15% return. Now you just got to watch out if the market turns, what that's going to be. So the first thing is a loan package when we're going to develop that. So the first thing is, when I'm developing a unit trust up here, I'm looking for lenders. I can go out to the bank, but you know what the banks are like. They're very slow to move, so on and so forth. So if your bank's going to give you an LVR of say 50 or 60, which is fine, you might be able to top it up to 80% or even higher. And remember, it's all at arm's length with our SMSF investors. In fact, if the bank's charging 12, you might have the SMSF investors coming in at MES at around about 15%. So the next level is then we've got the development units. So primarily the development units are capital units. So they're not going to see any income. because essentially what's happened is the property development is going to carry on there. These guys are in there to pick up, they're going to be part of the developer. So this is where the developer is looking at offloading some of their risk. It's a bit like a bookie. So rather than taking all the risk on, it's better off potentially to run 2 or 3 developments and do it in tandem with, for example, key investors. Now, to get these sort of investors is pretty tough. You can either go to family offices, and if you go to family offices, you're going to get pretty well screwed from that perspective. Like, they're going to go really hard on you. Whereas with SMSFs, we're obviously going to be in a lot better position there. So we can get our accumulation, our development units. Part of that unit, when we do a development and we're building that unit trust deed, what we've got there is we should have a choice of either getting a return on our dev unit, or alternatively converting it into an income unit, or acquiring the unit directly. So by that, if I go back here and have a look, so we're doing all our development, we're building our properties, etc. So this development unit here, let's say we'll call it dev units, we put our money in there. So that's our seed capital, which is completely different from our financiers. And again, if we're running at an 80% LVR on, let's say, a $3 million project, that's going to be $600,000 of seed capital. Now, those dev guys are going to have 3 choices. One is at the end of the development, we've got a choice there, is that this investment vehicle here is either straight in development investment vehicle, or it switches from development to investment. So what we've done is we've then gone down the track, we've got all those properties, and now we can either sell the properties out, as I said before. Alternatively, we can give our dev guys the option of converting their units from the capital to the income units. Or likewise, if there's a properties in here, the dev units can actually acquire the properties that are sitting in there for a discount, if that makes sense. Does it make sense, Michael, what I'm going through?
Yep.
Yeah, so what we're doing now is you can actually start to see it's getting into some pretty sophisticated playing around in this $800 billion market. So then the other side of the coin is that we can also, for the pension guys, we can also have income units going down the track. So at some point in time, when this property development goes from dev into income investment, so we end up with all the properties sitting in there, at that point in time, the developer wants to get out, which is okay. The developer units, we showed how that gets out, and then we can get new income unit holders in. So we can either sell the properties out, which is fine, or alternatively, we can just bring other investors into that particular unit trust, and that will then give them those income units. Or alternatively, like if we really wanted to, we can also look at these underlying investments as well. From a marketing perspective, is that for these ones here, because obviously we're going to be in a position here that we still want to market these to an SMSF. So what we can do is we can sell options or issue options to SMSFs to buy these assets at a set price. And if the market's going up, why wouldn't you do it now if you know it's going to go up in a couple of years, if that's what your belief is? So by doing an option now, the good thing about this is rather than remember with the SMSF, with an LRBA, you can't do a house and land. Here you can do a house and land, because the house and land is actually being done inside there. So the super fund's already got an option, and then what happens, we've got there, then that flips out over there to the superannuation fund, and then they can do their own LRBA as it comes out from there directly to that superannuation fund. So a super fund can do a straight income unit where they're obviously part of the income, or alternatively, they can flip that property out and then do an LRBA over that property as well. So that when you have a look at the basics there, which is nice to compare what actually is achievable under current laws and current structures, it's completely different scale of things. So again, if we build it for the SMSF, then of course we can still have all the companies, trusts, other investors coming in at any point in time around there. So if you're doing a structuring there, as I said, the key components that I'd be looking for in terms of these investments, I'd be looking at breaking it down into its components. As I said before, we need to have a lender, and they can be either the banks or fixed income investors. So as I said, this is fine for SMSFs. It's perfect for SMSFs, but again, there's risk involved, etc., so on and so forth. The next stage is obviously then the developer, and the developer can be then the investors themselves, which is virtually in tandem with the developer. And when you have a look at this, this is a nice little structure to be able to go to builders with. So if you get well with a builder, you can go in, see the whole thing, and virtually run off there. With these investors, though, they can then move into the final stage, which is post the development. The investors can either buy options or acquire an option. So that is akin to off the plan, but it's a way of doing the off the plan and working for an SMSF. The other side of the coin is in terms of when we have a look at the buy of the option, we could alternatively, that means that the property will go out. Alternatively, we can just have an income unit, and then that just shares in the underlying income there. So if we have a look at that, that's the sort of the element there. So when we're building a unit trust, and I'll just go through with Mick, when we have a look at the capital requirements, particularly in terms of Corporations Act, I mean, how would you structure this to make sure it doesn't fall foul of the managed investment schemes?
It depends who your investors are in relation to it. So if you've got sophisticated investors, you're fine. Yeah, and it depends on the number of investors that are coming into it. To be honest. So,
okay. Couple of things here. Natasha's raised a good one. So let me just get a couple of sheets. I'll move away from the green. I might move into yellow now. So this is you can build this for like a $1 or $2 million development. You can also do it down at a low rate. So Natasha's given me a great little issue here, and I've just done this with a couple other people. So when we have a look at it, what's happened is when we have a look at the family structure, if people are structured properly, and we want to get to that, so we've got our family protection trust. We might have a discretionary trust, which is basically trading or a trading company, either one. And then hopefully we've got an SMSF. Although I must admit, it's so scary when I have a look at a lot of property developers, how few of them got any money inside SMSFs. Whereas it, anyway, they should have had a really big component in SMSFs. So when we have a look at that, we might be sitting on a whole range of things. So what I want to do now is just have a look, because what happens if a client in one of these entities has got property. So just got land. And of course, we could have individuals as well. I think this is where Natasha's getting to. So the question is, if I'm going to go through the development, now I can do a development here through a special purpose unit trust. So you don't want to, if it's going to, what I'm doing is I've had a look now at something that was more at the multi-investor scale. Now, what I'm looking is at the individual down at the bottom level, for people who want to do small scale developments. So if I'm going to do a land development, so that is going to be obviously surveying, fixing up roads, getting in sewerage, electricity, etc. So the question is, to what extent can I do that in an SMSF? Now, again, the SMSF can't borrow to do a development because you'll probably end up with a completely different asset than what you started off with. So that would be a replacement asset. But what we can do is at some point in time, and you'll see this in the Commissioner's ruling, business real property ruling, so I think this is really important for you to have a look at. In the business real property ruling, the Commissioner looks at a land developer. So that if you've done land development or you're in the midst of land development, effectively you can transfer that into an SMSF. Now, likewise, if you're a property developer, so let's say we've got residential properties, then at some point in time, when do those residential properties become business real property? So if we're getting, for example, we might have a couple of blocks of land, and then what we're going to do is put 5 townhouses on it. Then if we've just held that blocks of land, we've never done property development before, so we're not a property developer. At some point in time, though, once we start developing those properties, if it's a reasonable size scale, we will move from an investor into a business, if that makes sense. We'll move from an investor into a business. And at that point in time that we go here, likewise with the land developer, if you're a developer, have a look at that business real property rule of the Commissioner. At that point in time, when we switch over, when we hit that magic mark there, and it moves from individual investment, Natasha, to business real property, at that point in time, then we can start to get the SMSF investing in it. Whether it's for the SMSF to complete the development, and remember, it may be at the back end of the development, because traditionally, when you have a look at a development, you'll start off with, I'll come back here. So when I have a look at a development, I buy the property, usually here, and it's worth, let's say, a couple of mil. At that point in time, I then start works on the property. And at that point in time, the value of the property is probably going to go down. It may go up, may go down. But, if I've got a big hole in the ground, there's a good chance there that the property is not going to be worth 2 mil. It's probably going to be worth 1.8 mil or even less. Because obviously you got to fix up, you can't just deal with a hole in the ground. If anyone wants to use it, you have to do it or put in, whatever. So depending on the quantum, it may go down quite substantially. Then if it crosses that Rubicon and it goes from business real property, then we can then pick up the upside of the development inside the self-managed superannuation fund, if that makes sense. Because we could buy it here, or we could buy it here, or we could buy it here. The big issue that you're going to need for this, if you're looking at doing these sort of things, is valuation. When we go over, what is the valuation of that transfer? So the key issues is it business real property? Yes. Secondly, can we borrow to fix up? Well, probably not, but we can use the cash inside the SMSF to actually do the development. So that's fine, particularly if you're just buying, let's say, a property, throwing out a kitchen, so you're doing a reno and a repair, then that's very easy to do inside a self-managed super fund. Very easy, and you can get obviously an LRBA. The development of the property or the kitchen renovations can have to be paid by the SMSF as opposed to the bank. So we can borrow and then obviously do the renos in there. If you're looking at converting it from one to another, then we obviously can't borrow. So when we go through this process here, we have to look at what cash is in the SMSF. And then what we need to look for is what other structures do we have? So for example, it may well be the individual, it might be a discretionary trust, it might be a company they've got. It might even be, for example, a bucket company that's flush with cash. That could act as a financier or a joint venture investment or a joint venture investor with that superannuation fund. So if you have a look at the Commissioner's guidelines in terms of property development, I've got quite a separate webinar that I've done on that one, which goes through the ins and outs of the property development according to Commissioner's guidelines. In that one, essentially, the JV issue is fine. 1322C, look, we've used a couple of times. It's not as flexible. And of course, then we can go down the track and build our big arm's length one there, which is quite perfect. So with that business real property, the key issues that we're looking at in terms of this is where a client comes to you and says, look, I want to do a property, I've got a small one. And the idea is to bounce it off us anyway and consider how it can be done. The first question is, we should always be looking is, can it be done in an SMSF if they've got one? Now, if the clients have got money sitting in industry and retail funds, remember, we've got 6-member funds. So we can pull in quite a few people together. As an aside, and I'm just going to make this as quite an interesting one, with a 6-member SMSF, I have seen 6 investors putting money into one, what's actually was 4 in those days, 4 investors putting money into one SMSF. Rather than having their own ones, they've put it all in there for one property development, if that makes sense. So when we have a look at that sort of style of things, we can start to build up our cash, pull cash from retail industry funds, do small scale property developments. I mean, the easiest one is the reno one. Go and buy a property, do an LRBA. What's your current LVRs you can get at Latrobe or, what's the group that you use for LRBAs now?
I'm actually getting LVRs for both resi and commercial up to 80% at the moment. It's fantastic. The commercial rates I was shocked, the LVRs I was shocked with the other day. So they're generally sitting around that 60%. So it can go up to 80% as long region dependent, obviously, where that commercials, but yeah, 80% LVRs on resi, easy.
Yeah, so
good rates too, Grant. The rates have peeled off a bit more, which is really good, and no requirement in relation to cash holdings in the fund, which has changed.
Well, that's pretty good.
Yeah.
So if you've got those T's and C's as well, you can use that, those T's and C's of 80%, rather than using the safeguard. You can use that sort of offer if you can get one in terms of doing a related party borrowing, if you want to go down that track and start pulling money out, but that's sitting in there for you. So the base one you can do is, super fund buys a property with an LRBA. It's got cash in there already. How do you get cash in? You can get cash basically through contributions. You can do your forward contributions now of up to $330 per person. You've obviously then got your concessional contributions of 27.5. And remember that now goes up to age 75. We're still waiting for the legislation on that one, but that's going to pop out pretty quickly. So we can do that. We can buy the property, LRBA, do a reno from that. Or we can go up a little bit higher. So we buy a property, house, knock it down, demolish it, put on 2 townhouses. So 2 townhouses, one for sale and one for residing inside the SMSF. So how do we go about that one? Well, because we're going to have two different styles of investments, we won't necessarily be able to borrow on that. So we'd have to fund that all internally within the SMSF, or that's where we use the JV. So we may have the individual who borrows on the back of the equity of their home, throws that capital in to actually do the development, while the super fund actually acquires the property itself, and they mix it through there. So you can start to see what we're doing is, if we're always focusing on this SMSF, we're doing this to drive down, because at the end of the day, when we have a look at the profiles of our clients, we've got, where's my little green one here? When we have a look at my profile there, the accumulation people are paying tax at 15% or 10% on the sale of the units or the props, whereas in the pension, they're not paying any tax at all. Whereas for most of your clients, they're going to be on 32.5% or higher at best. And even if you do it in a trust, you're going to end it up in a bucket company, which probably would be treated as, depending on what you've got there. If it's a passive investment, then you could end up having only paying 25% tax on it. But long run, it's obviously the best way to do it is through that self-managed super fund from a tax perspective. So we need to go in and have a look at any property development that a client is doing. And I wouldn't say, and look, this is probably the best question I can give to you as well. It doesn't matter whether it's property development, it's anything. I mean, we're in fact doing one for one of our accountants in terms of buying broodmares inside a self-managed superannuation fund. The first thing is, if a client comes to you with a transaction, is, can my SMSF be involved? And if they don't have one, you can always set one up. So if we focus in on that, then that's always going to minimize the taxation. Of course, it's going to increase the underlying requirements around what to do and how to do it. But don't worry about that one, because look at Abbott and Michael, we've got you covered there, as well as Ventum Optimum. We've got you covered because we know, we've done lots of these, so we know how to tweak everything out. And then again, just like these other ones that we had here, the last one, we had this one. We can actually show you how to build all different options for clients. So if you've got clients that are property developers, etc., it's absolutely crucial to have a look at some of these issues as well. Now, I could go from here, I could go through a lot of these slides, but essentially what I'll do is I'll send the slides out to you anyway around a lot of these issues, but I felt it was better to do a bit of freewheeling structuring for this at a high level. There's a lot in here about, obviously, discretionary unit companies, SMSFs. We talk about Corps Act, etc. In there. That's the issues that Mick alluded to. If you're doing it through a syndicated unit trust, you're getting involved there. Just be careful if you're getting specifically involved. But obviously, with wholesale investors, you can just raise as much capital as you want. You don't have to worry about getting a prospectus. Sophisticated investors, they get taken out of the pot, and then it leaves essentially 20 investors. You can raise $2 million from them in any 12-month period, which can end up being quite a sizable amount from a Corps Act point of view. This is the Commissioner's ruling. When we send out the recording later on today, we'll have that guideline there for you, which is a bulletin on SMSF, so you can understand the Commissioner's issue is around. There was a really good one where they were using a unit trust, and effectively they geared it up so heavily, and there was hardly any contribution made initially into the unit trust by the SMSF. But they might have invested maybe 30 or 40, but they ended up with a couple of $1 million of profit going into their pension phase. And obviously that sort of stuff the Commissioner is going to be fairly aggressive about. But a lot of these issues and the problems we have with property and SMSFs, everything is solvable. As I said, off the plan, well, if you're worried about off the plan, why don't you just structure a simple pass-through unit trust? Now, the problem is a lot of developers want to do that all themselves, but it's very easy to have a mid-term structure that holds it for a period of time. You get other investors sitting in there from that perspective. As I said in that regulatory bulletin, you can do it directly, but obviously there's how much capital you've got in there. You can inject money in there, obviously. A JV, I like that one. That's a really good one, particularly if the JV partners, whether they're related or unrelated, can effectively provide the development finance or the development capital. Look, CES regulation 1322C, company or trust, I've used it in certain circumstances to get out of a hole, but essentially it's probably, if you have a look at the ATO guideline, it's probably not the best. A superannuation unrelated investment trust it's just simply the trust that we saw before, but I've built in some special purpose goals in there to make sure that there's not really an issue of going above that 50% threshold where we become an in-house asset from that perspective. Look here, have a look there. There's a lot of other stuff there as well. Lots of ATO case studies coming out, but look, from my perspective, that sort of gives you a bit of an idea on how to do some property developments. So I'll just have a look through any questions. So Paul, just chuck up any questions you've got at this moment around that. Could you have multiple clients involved with both the personal entity unit holding investment and SMSF unit holding investment and still have the unit trust class as arm's length? Absolutely. So the main thing there, Paul, is from an arm's length perspective, if you did have some SMSF unit holders, it's not a bad idea to do a superannuation unrelated investment trust. And so that's a special purpose vehicle. I can't believe that we've only got that for $99 up on the site. I mean, that in itself, if you went to a legal firm, that's going to cost you $1,200 to $2,000 just to do that, if they even understood what a superannuation trust is, because you can also do different classes of units there. You can have dev and different income. But if you're looking at a larger scale, then just come to us and we can tweak it for you. So the main rule there is that if SMSF and the group, which you've got here, personal, other unit holders, or other discretionary trusts, etc. If through a group you control that unit trust, then the underlying units themselves are in-house assets. So as a consequence of that, for example, with a SMSF may invest in there, we're just going to make sure that we don't go above that 50% threshold. So it also includes the appointor, but there's no appointors generally with unit trusts. We look at the 50%, you've got to have more than 50% to be an in-house asset, or that you control the corporate trustee. So you've just got to be really careful. I had one recently where there was only one individual who was going to control the company, and that would have fallen foul of the in-house assets. If the other investors are okay, because it's not for them. So you're just going to make sure you have a board, and if there's only two people in there, it's a rotating chairman. So it's just fixed, because otherwise you'd see that as a control. So again, you can do all of these sort of things. The issue about it is there's so many different options and choices that we've built up over time that really there's just so much opportunity. From that perspective, as I said before, we want to make sure that we have a bit of an issue in relation to that.
Ken just has a question in there as well, in the JV example.
Yeah, so in the JV example where sums buy the land, or some talking about SMSF, buys the land for development, does the SMSF have to purchase the land with cash? What else would it purchase it with? Yeah, that's okay. What else would it purchase it with, Ken? Do you want to just type in there? That'd be great. So, for example, it doesn't have to purchase anything with cash. I mean, one of the big ones that we're going to be, if you guys really haven't got on top of promissory notes are God's gift to to all strategists really, and we use it for contributions, we use it for the protector. You also see that we'll be using it for trust distributions going down the track, so we don't have a UPE. So if a loan, would it fail the single acquirable asset? Okay, so going back, okay, yeah, so that's going to be a problem, Ken, is that if it's a loan, you're going in and just buying land there. Obviously, if you put a property on it, that then creates an issue because you're going to end up with a completely different asset, and therefore that would breach section 67B and 67A of the CIS Act for that one as well. But it's not a bad idea to do a JV with another party, whether it's a family trust or whatever, it does the borrowing for the actual development itself. And where you do JV, you just got to make sure you have a good JV agreement. One of the ones also, make sure you've always got a really good, strong unit holders agreement as well. And my friend Simon over in West Australia will tell you that one. Shiv, for two SMSF JVs, can you cover if one member of SMSF is employer sponsor of the other fund member? So if it's two SMSFs, that's fine. Obviously, you should be aware that the definition of SMSF inside section 17A, you can't have an employee as a member of that fund unless they're a relative. But if you've got a separate SMSF, so if I go back to my little Mr. Squiggle here, if I can find it here. If I go back to my little Mr. Squiggle here, so going back to what you're saying, Shiv, so I've got two mates there. We've got the Shiv SMSF, and then we've got Mr. Mickey D's SMSF. So they've come together and they want to develop a property. So what we want to do there is you could set up a unit trust. So there's two ways of doing it. We could set up a unit trust. And remember, that's going to be the superannuation unrelated investment trust. 50% here and 50% there. Now, as soon as you do that, the CIS Act falls away. The CIS Act will look at investment strategies, look at what happens there. The Tax Acts will look at it, but the CIS Act does not look at the suit. So there's no review of the suit. So the suit can do property developments, can do land developments, not a bad one at the moment, land banking. Could even do one for Shiv there, can do an off the plan. So effectively, you can build these properties there and then distribute them directly down to both of the SMSFs if you want. There's so many options there. But in terms of borrowing, which is the real issue here, effectively, you can borrow, the banks will lend into that suit, provided you've got the right documentation, if that makes sense. So I would be doing that. An alternative is you can do a JV. The problem about the JV is you're going to have the property. The property will be owned either by one party or both parties. The hard thing there is you're not going to be able to get the borrowing, or the bank won't lend it to you, or if the bank lends it to you, they're going to want to charge over that asset. I find when you're dealing with SMSFs, that just creates, it's just a bit too hard for the banks. It's good that they can do LRBAs, but if you're getting something a bit more sophisticated than that, it's just, it's a bit of a tough one. Okay, that's for shift. Okay, so that's perfect. We're a little bit over time, but look, this recording will be up around, one member of MIC is employed by business where, no, that's okay. So don't worry about that, Shiv. One member of MIC's SMSF is employed by, where Shiv's the director. So they're not related parties at all. So that's fine. Hopefully I'll see you tomorrow. Remember, we've got our session. It's on the Home Protector, brand new release. The documents aren't there yet, but I want to take you through the ruling, private binding ruling, how to structure it, what to do, get it all ready for LightYear Docs 2, which we're expecting to come up in November. I know you've had a really good look at a lot of the aspects of it, Mick, and what's so far, what do you feel about it?
Oh, looks absolutely. I mean, I've got a vested interest, but absolutely awesome, Grant. You know, the new client app, which is being built, is just brilliant in terms of our, you know, what our big disruptor to market is in relation to our strategy and our support, our human support, and how we deliver that. But the document engine and the new documents, we've been working on all of our documents, and they look incredible. We've had Megan working hard in our team and the rest of the team reviewing them. And I know you've got a lot to roll out. I've got some new ones around HR and stuff to roll out as well, which would be great for, especially for our small sole practitioners and some of their clients as well.
Yeah, so we've got a lot there. Shareholders, unit holders. As I said, we're very low pricing in terms of per document. I have people on notice that like that if you're on our pay as you go, you know, we still love you to death. Absolutely. So have as many $99 documents as you want, but a lot of the more complex documents such as Moat Castles Protector, Home Protector, Business Protector, LRBAs over shares, which I think is fantastic, and over property with related party financing, the prices will be going up on those. They're just too small for the value they're given. But for any strategist subscriber, obviously all of that value added, like tomorrow's, honestly, you'll see tomorrow, the strategy I'll be rolling out is worth between $5,000 to $7,500 per client. And just to be able to roll that out, and look, as I said, how many people in Australia don't need protection when it comes around to their underlying home? So we'll look at that tomorrow. But you've got a session on next week, Mick, partner session?
I do. We're just finalising that at the moment. I've just had a few issues in terms of we had to push one out from the other. I just mentioned on that we've got one coming up, but one of the panelists is bareboat. Not to rub this into our New South Wales and Victorians, but it's bareboat chartering through the Whitsundays at the moment. So I've had to change one of those. So that one, and I'll have you on that, Grant. That's going to be further jumping into property development and lending and what we can do there. So I think this session sort of mirrors into that well. And he's got a couple of products, a great product in relation to that they will actually go into the deals with you. A bit different than Mez, but he's got significant experience in relation to townhouse and other developments. And his group actually goes in and they'll manage the whole process, including the trades, and that they bring their own builder in. The builder gets an equity share in it, and the project's running out really well too. So
that's fantastic. And the other one is obviously, we're really pushing ahead with this. We're just waiting for the bank account because at the moment we can't become a member because we're just waiting, just painful with it. If you just want to let everyone know where we're up to with the bank account.
Yeah, we've got 5 directors. You have to have 3 directors on a public company, but post the Royal Banking Commission, it's been an absolute nightmare trying to get bank accounts. I mean, I've had it with clients as well, especially when they're located in different areas. So we have to obviously get identification. We have to have the wet signatures. We have to have either 2 or 3 attend the branch together, which is ludicrous. And so we're probably about a week off getting that finalised now. So Tim's been up in that and a few others.
Yeah. So once that's finalised, the next step will be to do a formal launch where we'll have the foundation members and also those of you who've gone through the accreditation. We'll be doing certification at that time as well. And then if you haven't made that, we've got another accreditation course coming up probably in November, which will coincide with LightYear Docs too. So we've got lots and lots of stuff on. But if you've got any clients that are doing property developers or who are property developers or even doing small scale, anyone doing any property, just put your hand up, and I'm more than happy to get involved, either I love accounting or through Abbott and Michael to help you through that. And remember, it's just not property. As I said, we've just given advice in terms of putting broodmares into a self-managed super fund. In fact, it works out to be a great little investment.
I'll certainly be looping Abbott and Morley and Grant in relation to that golf course. It's been I've been meaning to talk to you about that. So be working with you and Tony close on that. There was a fair bit of DD we had to roll out before we got to where we are.
Oh, I know. Yeah, it'll be good. It'll be interesting, actually, what we can do.
Yeah.
Daisy, if you've done the accreditation, what the next step is going to be, if you've done the accreditation, next step is to get membership, because then once you've got membership, then you can become certified. So at this present point in time, the directors have agreed, and you'll get an email from Sally Rourke and also Suzanne Bransgrove. And then part of that first year's payment will include certification. Going down the track, obviously, that won't be the case. There'll be an additional fee for certification, but certainly for our first founding members, etc., it's included. So watch out for that one. As I said, we would have liked to have had it up and running now, but it's lockdown and banks are just very tough. But look, thank you very much for all your time. And let's just go through from there. And Mitch, you don't need to have been through the accreditation process to be a foundation member. Anyway, that's enough for us. We've got work to do, but thank you very much for your time, you too, Mick. And we'll get this up and running very shortly with all the relevant guidelines, with the tax office guidelines, and also the slides as well. So thank you very much.
Thank you.